Hi everybody, Joe Conroy here, financial advisor, and today I want to talk about a financial topic that affects every single investor, and that is the topic of risk. So when we look at risk, really it falls into two different categories. The first category is unsystematic risk. The second category is systematic risk. Now, let me break that down in everyday terms. I try to stay away from financial jargon when I can. So unsystematic risk is diversifiable risk. An example of unsystematic risk is owning too much of one company stock. Or maybe you own several different stocks, but they're all in one specific sector. So you can mitigate that by not putting your eggs all in one basket. So you have several different baskets. It helps get rid of that one company having a bad earnings report and falling on its face, or if you have other stocks in other sectors and you have a more diversified portfolio, it can help reduce some of the unsystematic risk in your portfolio. And on the other hand, we have systematic risk. So systematic risk is, let's say that you've got your eggs in several different baskets here. Your portfolio is still going to fluctuate up or down depending on how you're invested. And that's just an overall function of the market and how investments work. So if you do have a fully diversified portfolio, it doesn't completely absolve you of volatility, right? You're still going to have volatility because the market will move as a whole. So if there's an earnings report or some geopolitical event or any number of different things that can move the overall market and have those, some people refer to it as a roller coaster ride. I don't think it necessarily needs to be that volatile, but your portfolio will move, and your statements, more importantly, when you get them on a monthly basis or whenever you go online to check your account, the numbers are going to be different, maybe day to day or month to month. And that is usually a function of the systematic risk or your overall market risk. So what I want to do now is I want to go into the office and I want to go on the whiteboard and show you really another concept of how we can visually see risk and how it affects our portfolio. So assuming that we have diversified out our unsystematic risk, which isn't to say that you diversify out risk, but just the risk that one stock, one sector blows up and doesn't recover. So we have a diversified portfolio. And before I get into drawing the graph, I just want to mention some useless financial trivia. At least I find it, maybe not useless, I find it interesting, but that's just me. And this is really modern portfolio theory, which was pioneered by Harry Markowitz in 1952, and that essay that he wrote on modern portfolio theory went on to earn him the Nobel Prize in economics. So there's your trivia for the day. Now, what we've got here is a y-axis and an x-axis. On this, we've got expected return that we assume that we will get based on a certain level of risk, which is represented on this part of our graph. So, modern portfolio theory and the efficient market hypothesis works this way. That based on a certain level of risk, you can assume a certain level of return. And right down here, we're going to start at the corner, and that's zero. So 0 return, 0 risk. Right now, that's closest thing is going to be cash. There's a little bit of money and interest if you lock it up in CDs and things like that, but let's not get in the weeds. Money markets or cash or checking is going to get you 0 risk, 0 return, right? So if there's one step over on that risk scale, it's likely that we assume we'll get this level of return over a period of time, or an average rate of return, right? Not every year, but so this 1 unit of risk will get us 2 units of return. So a lot of people that are stuck in cash, they might think, well, I have to put all my money in the market or I just leave it in cash. And there's many different checkpoints other than just all in or all out. So anyone that is sitting in cash, consider just taking one step out in that risk scale and you get a little bit more return for the risk that you're taking. But anyway, what we can see here is that there is a little bit of a efficient portion of this chart. So if we're going to come on down to here for our risk, we're going to get this level of return. Let's say that this is the efficient, kind of an equilibrium. So this is a good balanced mix, a balanced portfolio that's fully diversified, right? And again, just for illustrative purposes. When you're younger, you can afford to take more risk and you get an assumed higher rate of return. But here's really how that works. If you want, say, this extra level of return, you're going to come out here and take this amount of risk. I didn't really draw this completely to scale, but you can see that you're taking more risk to get a little bit of return. So there's some diminishing effects. So, the risk was helping us to get excised returns. It starts to work against us the further out on this chart that we go. Now, when you're in retirement, you might think, a lot of people, I didn't save enough. I need to fund a shortfall for retirement funding. I need to get more return. Well, what that really does is subject us to more risk. So here you've got steady. This, you have a little bit of market gyration. Here you have maybe a little bit more. And then here you're kind of all over the place, right? So it gets more and more volatile, which is another name for risk, the further out you go. And the further out you go, you're only going to get a little bit more return for that extra risk that you're taking. So when you're in your, say, 20s and your 30s, it makes sense to try and get an extra 1% return on your portfolio every year because you're not going to touch the money for a long time anyway. Well, that's when people start to say you need to get more conservative the closer and into retirement you get, is because you really don't want your portfolio bouncing around as much as it did when you were younger once you get close to retirement. So maybe this is a good point if you're in your, say, 50s, 60s, and 70s plus when you're deeper into retirement. Subject for a different video, there's the risk with volatility is sequence of return risk. If you have a bad couple of years at the beginning of your distributions, it throws off the whole thing. And that's not really something, if you have a couple of bad years when you first start investing, it doesn't affect your average return, doesn't affect accomplishing your savings goals as you get closer and closer to retirement. So at the end of the day, this is, again, very fundamental. If you have a diversified portfolio, it will fall somewhere on the scale depending on how much stocks to bonds that you own. And who do we have to thank for this graphical representation? Harry Markowitz. So hopefully this is a tool that is helpful and helping you understand where volatility fits into your overall investment strategy. I think it'd be important for you to find out where on the scale you are in your investment strategy and if that does line up. If you are over here and you are in retirement, I would say that you need to be aware of that. Maybe that's not the intended goal and you really should kind of back it down to here. Or maybe you're down here and you need to get somewhere up here and try and get some returns to help you get a little closer to those goals. So hopefully you find this information valuable. And if you do, please like and subscribe to the channel. I would appreciate the support.